Professor, great to have you on the show and have an opportunity to once again catch up with you on all that's happening, and particularly with markets at these consistent records. We know it's backed by the Fed's easy money policy, but nonetheless, it surprised everyone. Retail investors in particular are wondering, have they missed the boat this time around? What does a retail investor do, Professor, at a time like this?
I'd like to, first, get rid of this distinction between professional investors and retail investors, because implicit in that distinction is somehow the belief that professional investors know what they're doing. I mean, I've had 40 years of dealing with mutual fund managers and hedge fund managers, and trust me, they're just as ignorant and just as driven by greed as retail investors are. So rather than think in terms of what retail investors need to do, let me talk in terms of what investors collectively need to do.
Okay.
I think one of the first things you need to decide when you come into the market is why you're in the game. Are you in the game to preserve and grow your wealth, which is investing? Are you in this game to make money quickly, to get rich, which is trading? Are you an investor or a trader? And every person coming into the market, professional or retail, has to make that judgment first before they decide what to do next. So in this market, I think this is a trader's market. Investors are going to be shut out, but don't lose faith. Your time will come.
And that leads me to my next question, because you've been a proponent of value investing, and I know over the last couple of years we've also discussed how perhaps the old metrics of value investing have changed, low PE for example and so forth. What does an investor look for today? Do they go for growth? Do they look for other metrics to define what perhaps makes a good investment?
The first thing is we need to realize that when you use a metric, you're using a shortcut, right? When you use PE, price to book, any multiple, using a shortcut and hoping that it gives you undervalued companies. I think increasingly we live in a world where those shortcuts don't work. The alternative is, and you're not going to like what I say, requires that you do the hard work of assessing what value is and where it comes from. And that's a much richer question, because value can come from not just earnings last year or earnings next year, but it can come from growth, it can come from the cash flows you generate as a business. You can be a value investor and buy a young growth company that's money losing. I know that sounds contradictory, but a young money losing company at the right price is a much better investment than an old mature money making company at the wrong price. So I think we need to expand our definition of what value is for value investing to make a comeback.
Okay, so let's talk about some of the big tech listings and IPOs that we're tracking here in India. We all were looking at your comments and monitoring them, and there was quite a bit of debate around it, particularly when Zomato was going in for listing and seeing those prices ahead of that as well during the IPO period. But it's not just Zomato. We're heading into a period where we have Nykaa, Policy Bazaar, Ola, companies with $3 to $4 billion of valuations that are going to be hitting the market, and that too this year. It's going to be pretty busy. Is your skepticism across the board at tech companies altogether? Was it limited to Zomato? How would you view this space?
Yeah, I almost never extrapolate beyond the company I'm valuing, because the danger of extrapolating then you get sloppy. You say, look, I'm not going to buy a tech company because all tech companies are overvalued.
Right.
So I plan to look at tech companies one by one, and I'm always open. I never say never. So when I look at a Zomato, for instance, I'm never going to say, no, I will never invest in Zomato. At the right price, I would obviously invest in any company. Which means due diligence requires that when I want to look at a stock, I've got to look at that stock, not make a judgment about a whole group of stocks.
Okay.
So I do think that we're in a period where IPOs are more likely to be overpriced than underpriced. But that doesn't mean that one of them might not make it onto my radar as a fairly valued company or an undervalued company.